Now, thus far, we've looked at Berry Computing, we've looked at their liquidity ratios, and we're now going to look at their profitability ratios. Now, the profitability ratios, you recall, measure the performance of the company. And as a company now, how you would measure performance, of course, is a function of how much earnings do you generate. And so all of these ratios now are going to have some measure of profitability in them, typically in the numerator. And the first one we're going to look at now, this is called the net profit margin. And this is strictly about the income, the profits you generate on the income statement. There's no assets, nothing from the balance sheet in this ratio. And it's defined as net income over sales. And if you look at the net income of Berry Computing, you'll find it's $27,300. If you look at the very top of the income statement, you'll find sales. And sales for Berry Computing is $1,607,500. That gives Berry Computing a net profit margin of 1.7%. The industry average is 1.2%. Now, being able to make 0.5% more in an industry where the profit margin is 1.2%, that's very good. Berry Computing's ability to generate profit, net income, off its sales is superior to that of the typical firm in the industry. The next one we're going to look at now, this is called return on total assets. Sometimes simply called return on assets, sometimes referred to as return on investment. But nonetheless, your author wants us to call it return on total assets. That's net income divided by total assets. Net income, again, off the income statement, $27,300. The total assets number off the balance sheet, $947,500. That makes the return on total assets for Berry Computing 2.88%. The industry average is 3.6%. Now let's remember from our activity ratios that Berry Computing has a lot of money tied up in accounts receivables, which is an asset. So in essence, its asset number is sort of bloated. It's too large. And so the denominator here should be smaller because it's not. So because it's a larger number, you get a smaller profit margin here. So that's the problem that Berry Computing is having. And the way you would interpret this particular ratio is that Berry Computing's ability to generate income off its investment in total assets is below that of the typical firm in the industry. Return on equity, now ROE, is probably one of the most widely watched financial ratios there is. Return on equity. Equity now, you'll recall, this is the owner's investment in the company. So this is widely watched because people think, well, if I put my money and invest my money in the company, what return will they earn on my investment? And again, that investment would be called equity. Now, return on equity is net income divided by equity. Again, off the income statement, net income is $27,300. Off the balance sheet, you find equity to be $361,000, giving Berry Computing a return on equity of 7.56%. The industry average is 9%. Berry Computing's ability to generate income off owner investment in the firm is below that of the typical firm in the industry. Again, I would attribute everything at this point to them having too much money, too much of their cash tied up in accounts receivables. Return on invested capital. You take earnings before interest and taxes, your EBIT, and multiply that by 1 minus the tax rate. And that gives you the after-tax earnings before interest. And interest is something you pay on some of your invested capital, the debt. And indeed, in the denominator, the invested capital is the debt plus the equity. Off the income statement, you find EBIT to be $70,000, and you find that Berry Computing's tax rate is 40%. So 70,000 times 0.6, that's the numerator. The denominator, debt plus equity. Now debt, off this balance sheet now, you have in the current liability section, notes payable. that's viewed, that's a long-term debt really. It's due in the next year, but it was a long-term debt. You would add that to the long-term debt of barrier computing, and that gives you the total debt of the company. To that, you would add the equity of the company, $361,000. And that gives barrier computing a return on invested capital of 5.99%. The industry average, 7.5%. So barrier computing's ability to generate earnings off the invested capital is below that of the typical firm in the industry.